Scott Chronert is a U.S. equity strategist at Citi Research. Scott, what do you say? Welcome.
Welcome. Thank you, Kelly. So, what I would say on this is that you got two different components at work here. Going into this year, what do we know? We know that the S&P at 24, 25 times trailing was pricing in something approaching soft landing, if not Goldilocks sentiment. That's coming into question as a function of the broad array of Trump policy initiatives. But also what you know is that the expectations for U.S. equities have begun to price in a perpetuity of earnings growth that we measure in the low to mid-teens, call it 14%. So the bogey that you have for the Q4 reporting period to beat and then follow through with upward revisions to maintain the momentum in this market has been fading. And in fact, what you've seen is, yes, very good Q4 earnings, but at the same time, earnings expectations in aggregate for the S&P for 2025 have been falling, down from roughly 278, let's say 3 or 4 months ago, to 271 currently. So this is a headwind that I think suddenly falls underneath the traditional macro playbook.
So you're I don't know if you heard that kind of discussion debate just now, but it sounds like you're in Barry's camp, a little bit more concerned about a soft patch here.
I'm not concerned about inflation. Okay, I'm concerned about fundamental follow-through to justify the price action. And I think in aggregate, what we look at in terms of the broad array of Trump policy initiatives is that at some level, particularly as you go down the cost curtailment path, is that you begin to change the positive fiscal impulse that's been at work in this market supporting consumption since the pandemic. So, yes, we're a little bit more concerned about growth here and what's being priced in that regard than we are about the traditional macros.
So when we look at the tech kind of epicenter of this, you could easily build a narrative that just says, look, it was overbought. Some of these multiples were overextended. Meta was on a 20-day win streak, and we're just unwinding that. Are you kind of talking about the unwind of momentum, or it sounds to me like you're talking more about something more fundamental that could develop 3, 6, 9, 12 months from now?
It comes back to what you think about growth stocks, right? And so these companies, the Mag 7 in particular, NVIDIA is the poster child for this, have been living off of a persistent beat and raised outward guidance for the better part of 2 years. What you've been seeing with NVIDIA is a deceleration in that pace of upward revision. And with the rest of the Mag 7, you've actually begun to see it roll over, flatline to roll over. So essentially what you're setting up for is a change in sentiment for how you're pricing in longer-term forward growth-looking expectations for that Mag 7 cohort. What this means is that you potentially go from good stock to good company, but more mediocre stock performance versus what you've gotten accustomed to over the past 2 years.
So I hear what you're saying, and then I think about Barry Knapp's comments about earnings season. The only kind of like forward upward progress we're seeing is coming out of the financials and energy space. And a lot of the more defensive sectors, even like staples, didn't look so good or screen so well to him. So where are you looking to?
So, we've been aligned for some time now. We're overweight financials, so we're on that playbook. We've been overweight on communication services as a way to tease out these, AI creators, if you will, through the internet names. We're also overweight energy in a contrarian mode. And then, I think lastly, we've gone overweight healthcare going into this year, which got beaten up pretty significantly last year, four multiple turn lower valuation to start this year versus 6 months ago. So all told, we're being a little bit more balanced between growth, defensives, and cyclicals, and where we're underweight, consumer discretionary, industrials, materials, and staples.